Good afternoon, everybody, and thank you so much for joining us for our risk-based approach FICA webinar today. I think we are about 2 minutes late. We had a bit of technical issues on our side, but luckily we are all here and we are very excited to be speaking to you for the next hour. My name is Ira Gunning. I'm an executive in the Banking and Finance Department at ENS, and I specialize in FICA, anti-money laundering. I also specialize in data protection and consumer protection. So without further ado, let's get straight into it. So we are going to discuss the changes that have been made to FICA in the last 6 months or so. And we are specifically going to focus on what is meant by a risk-based approach. I'm also joined by Suad and Jimmy, and they will introduce themselves when it's their turn. So first of all, what is money laundering? Now, we've got all these legal definitions referring to proceeds of unlawful activities and all sorts of fancy legal terms. But what is money laundering actually? Money laundering is trying to hide the fact that you are dealing with proceeds of unlawful activity. So you've got crooked money, you've got dirty money, you're trying to wash your money. So you're trying to hide the fact that it is money that comes from hijacking or money that comes from drugs and so on. And this term was apparently coined or initiated in the days of Al Capone, when he actually set up laundromats to hide the fact where his money that he obviously made from racketeering, illegal alcohol sales and so on, he tried to hide where the money came from. So this is exactly what money laundering is. We're trying to get into the banking system, we're trying to get our money into a bank, and we're trying to make it look like clean money. Terrorist financing, I think we all know what that is. Terrorist financing is obviously when finance goes towards things like 9/11, to explosions, to attacks, and so on. And then since December this year, we've had quite a lot of focus on proliferation of weapons of mass destruction, and that has been added to FICA in terms of the General Laws AML Amendment Act. Now, proliferation of weapons of mass destruction is financing nuclear weapons, so spreading or financing nukes. Now, of course, money laundering, financing of terrorism, proliferation of weapons of mass destruction, these are bad things. And for that reason, we have laws in place to try and curb it. And FICA is one such law. But we cannot speak about FICA at the moment in South Africa without speaking about the Financial Action Task Force and the inspection that they did on South Africa and the fact that they were not happy with where we were at with anti-money laundering and the like. And that is why we were grey listed. Now, a lot of people talk about the Financial Action Task Force, but I'm not sure if everybody actually knows what the FATF is. So the FATF is an intergovernmental anti-money laundering watchdog, and it sets recommendations for its members. And South Africa is a founding member of the FATF. So what the FATF does is it makes recommendations, and their recommendations are the global standards on anti-money laundering and, of course, the prevention of terrorist financing and the like. So these recommendations do not automatically apply in South Africa. We need to write them into our laws, and we also have to enforce them. Of course, it is one thing if we have these wonderful laws, but they're not enforced, and the money launderers and the like are not sitting in jail. So when the FATF came in 2019, they did a peer review. Now, a peer review is basically an inspection, and they marked us. They marked us against our academic compliance, called technical compliance, and also if we are actually implementing our laws. And as far as our technical or academic compliance is concerned, they marked us against 40 ratings. They checked our legislation, and we basically failed. And they said to us, we are coming back towards the end of 2022 to see if you have fixed these laws and are you implementing these laws, and then we're going to make a decision as to whether you are going to be grey listed or not. We know they came back They found that we didn't do enough and we were grey listed, which puts us in the likes of, or in the company of Nigeria, Cambodia, Cayman Islands, Burkina Faso, and so on. Now, what does that mean? What does it mean when we are grey listed? It means other jurisdictions and other members of FATF see us as a jurisdiction with a high risk for money laundering, high risk terrorist financing, proliferation of weapons of mass destruction. So it seems to the rest of the world that crooks like to live in South Africa because it seems like we are soft on them. So of course, we are now going to have to try and prove the FATF wrong and try and get removed from this grey list. Iceland did so within a year, Mauritius did so within 2 years. So obviously, we are going to want to impress the FATF now. So we made quite a few changes in an unsuccessful attempt to try and avoid the grey listing. And that all basically happened towards the end of last year. So what did we do? We changed the schedules to FICA, and specifically Schedule 1 was amended. What is Schedule 1? Schedule 1 tells us who is an accountable institution. An accountable institution, traditionally the likes of lawyers, banks, financial services providers. These are the entities that must FICA their clients. We all know when we go and open a bank account, we get FICA'd. When you give ENS an instruction, we FICA you, and so on. So that list was expanded to include a number of new accountable institutions. And we'll look at those new accountable institutions in a minute or so. We also saw the passing of the General Laws AML Act, and that was passed in December. That changes 5 pieces of legislation, and we'll speak to that just now. And we also saw our POCTATARA Amendment Act being passed. So POCTATARA is our Anti-Terrorism Act, and for the main, what has happened there is UN sanctions are now will be automatically recognized into our law without it having to be published in a gazette. So that was one of the main changes, and the fact that a person who's been sanctioned, their assets can be frozen. So I've mentioned that Schedule 1 to FICA was amended. Now, the following are now accountable institutions, and they've been accountable institutions since mid-December. Life insurance business, short-term insurers were initially going to be included here as well. They were not included in the final changes. Credit providers regulated under the National Credit Act and also not recognized or regulated under the National Credit Act because they lend money to the government or to juristic persons with an asset value or turnover of above R1 million. So if those are your borrowers, you don't have to register under the NCA. But if you didn't register under the NCA just because of your clientele, but you still charge a fee or an interest or another charge for a deferral of payment, you must register as an accountable institution, regardless of the fact that you don't trigger the NCA. So credit providers under the NCA, not under the NCA, are accountable institutions, but only if they do charge an interest and they're not regulated under the NCA because of their client base. Business of a money or value transfer provider. Previously, it was just a money remitter that was caught by these provisions, but you can also launder money not only by means of money. It could be, for example, the transfer of airtime and the like. So that's why that has been expanded. Entities being in the business of dealing in high value goods where a item is above 100,000 Rand. Now, often we are asked, do service providers trigger this category? No, it must be an actual good, an item that you are selling. And we are also asked whether it's a basket of goods. What if I buy 20 cell phones and they are 5,000 Rand each? Would I trigger this provision? No, it is only when a single item is 100,000 Rand or more. So this is very difficult because if you're dealing with the likes of cement or grain or fuel and it's not divisible, it is our view that if you sell that in bulk, you would be a dealer in high value goods. Of course, if you sell a mountain bike or if you sell a prize bull, you could also be seen to be a dealer in high value goods. Many of these amendments were passed in quite a haste to try and avoid the grey listing by the FATF. And to be frank, they're not very well drafted. We don't have definitions for what is a dealer. When are you in the business of dealing in high value goods? We don't have a definition for item. So we don't know, should you only trigger these provisions if you are selling precious metals, if you're selling diamonds, or do you trigger these provisions because you're selling mountain bikes? But certainly the way the legislation is drafted, it would catch all those categories. Certain crypto asset services providers, and then certain trustees. Now, basically, if you're in the business of acting as a trustee and you basically do anything with a verb, you administer, you safekeep, you control trust property as defined in the Trust Property Control Act, then you need to register. The individual trustee needs to register, not the trust itself. It's the trustees that need to register. So if there are 5 trustees, for example, in an employment share scheme, each employee would have to register. So trust property in the Trust Property Control Act is basically any property that is being controlled or safe kept or being administered in terms of a trust instrument. So where you have your written trust deed, you've got a trustee doing something with property, you trigger these provisions. We've tried to play with what is meant by being in the business of, but in terms of the draft PCCs released by the Financial Intelligence Center, they say being in the business of as being a commercial activity, unlike a governmental body or charity or doing something on a once-off basis in a personal capacity, like a trustee in a family trust. So this is quite a wide-ranging category of accountable institution. So when you are an accountable institution, what does this mean? It means you have to appoint a compliance officer, and you need a compliance officer to register as an accountable institution online with a FIC-GoML, with their website. It's a free registration, and you need to do it yourself through your compliance officer. When you've got a trustee, if you go to section 42, it seems like an individual doesn't have to appoint a compliance officer, but you run into trouble when you do try and register online if you haven't made such an appointment. Very importantly, you have to develop and implement a risk management and compliance program, an RMCP. And Suad is also going to speak more to what this document is. But very, very important, this RMCP is an AML policy based on risk. And the risk assessment and the risk controls implemented in terms of your RMCP are so important at the moment. This is on the radar of all the regulators. When they do inspections, they want to see that you have customized your risk-based approach. You need to do training as well. Now, as far as your RMCP is concerned, it needs to comply with Section 42 of FICA. Very important that you use Section 42 as a checklist and you make sure you cover absolutely everything set out in Section 42. Even if a paragraph does not apply to you, for example, you don't deal in cash, then you must make it clear that that paragraph doesn't apply to you. Your RMCP needs to be approved by the highest level of authority, and where you have a board of directors, they also need to make sure that your RMCP is rolled out and implemented. Now, briefly, your RMCP must cover a lot of things. For example, how do you determine whether somebody is an existing client? How do you determine whether somebody is a prospective client? Are you entering into a single transaction or business relationship with a person? Very important that you identify in your world, when is it a single transaction, when is it a business relationship? Where you have a business relationship, you have to do more than you would have done if it was just a single transaction. For example, you have to monitor transactions. You have to do sanction screening. So a lot more obligations kick in when you've got a business relationship. So you need to clarify, when do you have a business relationship? Incredibly important. And again, this is so Jimmy and Suhad's field, but you need to identify, assess, monitor, mitigate your risks. Incredibly important. You have to make it clear that you do not deal with anonymous clients. You have to set out how are you going to establish and verify identities. Establishing an identity is to ask somebody, who are you? I am Suad Jacobs. Verification is to check that Suad is in fact who she says she is. The higher the risk she poses, the more we need to do to make sure that Suad is Suad. So the risk-based approach, everybody needs to be identified, but the verification must be based on the risk posed. You need to check whether transactions are consistent with what you know about your client, your KYC, know your client. Is your client's behavior consistent with what we know about our client? We have to do ongoing due diligence and monitoring, and we need to do that in terms of the Protection of Personal Information Act as well. We need to make sure that our information is up to date and accurate. When we are dealing with legal persons, trusts, and partnerships, they generally pose a higher risk, and we have to do additional due diligence, including looking into their beneficial owners and verifying beneficial ownership. If you doubt the veracity of information given to you, what are you going to do to make sure that the information is accurate? How are you going to examine complex and layered and unusually large transactions or unusual patterns? How are you going to check whether this is normal, whether it meets what you know about your client? If you start seeing something is suspicious or unusual, and you must file a suspicious transaction report. And by the way, this is not only accountable institutions. This is anybody who does business in South Africa must file suspicious or unusual transaction reports when they think they're being involved in money laundering. What are you going to do to make sure that your customer due diligence is accurate and up to date? If you cannot conduct customer due diligence, you must terminate the relationship or not enter into transactions with this person. How are you going to determine whether a person is a politically exposed person or prominent influential person? Also note that the provisions dealing with PEPs and PIPs have changed due to the General Laws Amendment Act, and the Schedule 3A, 3B, and 3C to FICA has changed. So if you have an existing RMCP, make sure that you update the PEP provisions. You have to do enhanced due diligence, and I know Suad is also going to speak to that, on clients who pose a higher risk. You have to set out how you are going to keep records. Where are you going to keep records? Are you keeping electronic or paper records? Are you outsourcing record keeping? If so, you have to notify the FIC thereof. And you have to set out how you are going to determine if a transaction is reportable. If you have branches and subsidiaries in foreign countries, you need to set out how are you going to roll out the rules that you're implementing through your RMCP abroad. Are these entities allowed to roll out the likes of fee or the equivalent to FICA compliance? And what are you going to do if they are not? Very importantly, if you're part of a group of companies, you need to address the sharing of information. How are you going to share information? How are you going to maintain confidentiality? How are you going to avoid tipping off and the like? How are you going to identify suspicious transactions in a group? Are you going to have a single client view? Very often clients and groups have binding corporate rules, which is sometimes also a requirement in terms of the Financial Sector Regulation Act. Can also be your binding corporate rules in terms of the Protection of Personal Information Act, dealing with sharing information and to identify money laundering risks. You have to provide for the manner you're going to implement the RMCP and for any other prescribed purpose. The prescribed purposes usually come out in directives issued by the FIC. The FIC has recently issued 3 directives, and I know my colleagues are also going to speak to Directive 8, which talks about employee screening, which I know everybody is quite concerned about at the moment. I've already said that the RMCP need to be approved by the likes of your board of directors. very important that you distinguish between a rule-based and a risk-based approach. The rule-based approach was the old days until 2017, when the FICA regulation said exactly what needs to be collected from the type of client to verify their identity. If you were a human being, they had to collect, for example, a green barcoded ID or another form of identity, like an identity card. It was prescriptive. But that changed in 2017, and with the introduction of the risk-based approach. Now, the risk-based approach says spend your money and implement more expensive controls for those clients who pose a higher risk of money laundering. Incredibly important that you do look at Guidance Note 7 and Public Compliance Communication 45 issued by the FIC that sets out what we should take into consideration when we deal with a risk-based approach. Now, when we're dealing with risk, we have to look at threats, vulnerabilities, and consequences. The threats are those baddies who are targeting us. The vulnerabilities are, why would they want to use us to launder money through us? What is a weakness that they may use? For example, is there an anonymous transactions, for example, through cryptocurrency and the like, because that would make you more vulnerable. And then, of course, you have to implement controls. I'm not going to go through all the indications of risk. They are set out in the guidance note and the PCCs, and our slides will be shared with you. And I know my colleagues will also speak to this in more detail. But you would look at your products, you would look at your geography. Is the person, is your client in a high-risk jurisdiction? Is your client in South Africa? What type of client are you dealing with? Is it a corporate vehicle? Is it a trust? Is it an individual? Of course, corporate vehicles and trusts generally pose a higher risk of money laundering. But you will also have to look at other factors, such as the need for financial inclusion and banking the unbanked. Incredibly important that you note that no two organizations are the same, and your risk controls need to be customized. You can't just copy and paste from another organization. Incredibly important that you do assess the risk and implement controls to mitigate the risk of money laundering in your space. Accountable institutions must also conduct customer due diligence and also now employee due diligence due to Directive 8 that my colleagues will discuss. You need to keep prescribed records, and certain transactions must be reported. I've spoken a lot about the risk-based approach, and high-risk clients, you need to do more to verify who you are dealing with and to monitor their transactions. We need to do custom identification verification. And of course, again, if you've got a business relationship, you need to do more than if you entered into a single transaction. Ongoing due diligence, of course, it's not a once-off thing. What do you do if you doubt the veracity of information applied to you? You have to do sanction screening. Please remember, if you screen beyond the UN sanctions lists, there are POPI consequences, and you may hit special personal information, and you really, really should get a consent to do so, because it is very difficult to fit into the other categories or justifications for special personal information. Additional requirements like looking into the beneficial ownership, of course, when you're dealing with legal persons, partnerships, and trusts. I've mentioned record keeping already. And then our transactions that are reportable are cash transactions of 50,000 Rand or more, cold hard cash. It's your coins and your notes, or traveler's checks if anybody still uses them. If you have property in your possession of UN sanctioned persons, it is reportable. Suspicious or unusual transactions are reportable, and you must deal with requests from the Financial Intelligence Center and other regulators. Also, international EFTs must be reported by the likes of banks. Moving on, just wanted to mention to you, there are some important FIC directives. We've got the self-reporting directive, which if you miss to file a report, you need to file that report. You need to tell the FIC that you have to confess and say we've missed a report, and you need to do that immediately when you realize you've missed a report. Employee screening, Directive 8, which my colleagues will speak to. And then please note that accountable institutions must also mid-year now file a report with the FIC. That came out in Directives 6 and 7. And at this stage, I'm going to hand over to my colleague, Suad.
Hi, good afternoon, everyone. I'm Suad Jacobs. I'm from the Forensics Department. My colleague Jimmy will introduce himself when he starts to speak. We advise clients extensively on their anti-bribery, anti-corruption, anti-money laundering, and anti-sanction compliance programs. So we'll be speaking to the risk aspect related to that newly accountable institutions now have to address, as well as Directive 8. So the importance of proper due diligence for clients is a newly accountable institution requires a robust and appropriate client due diligence process as part of its overall anti-money laundering and counter-terrorism financing compliance program in order to comply with the requirements of the FIC Act and its directives, and not only to avoid the pitfall of engaging with clients who are engaged in money laundering or financing of terrorism, but also to demonstrate to the regulator that the accountable institution has taken appropriate steps to mitigate the risk posed by its clients. The process that we'll talk you through is applicable both in an anti-money laundering scenario, as well as anti-bribery, anti-corruption, and dealing with sanctions. Obviously, the focus in the program would be slightly different, but the key concepts and strategies that we're discussing here this afternoon would be applicable in all three environments. But we'll specifically be dealing with what is required from you in terms of the FIC Act. So the aim of a customer due diligence process, the aim of it is ultimately to gather sufficient information about your client to assess the risk that is posed by the client or by prospective clients that you wish to engage in a business relationship with, whether that's a one-off business transaction or a continuous business relationship. So you have to determine whether, as a result of the initial information that's provided by the client and that you've assessed, you are then required to engage in enhanced due diligence procedures so as to address any additional risks. So the typical risk levels posed by a client are traditionally categorized into three levels. Low risk, where depending on the risk appetite of the accountable institution, you may not want to do any further due diligence. Medium or high risk. And typically in the medium or high risk category, further enhanced due diligence procedures would be required. There may even be mitigatory procedures that you want to implement in the relationship with the client. It would also affect how regularly you review the information related to the client. So you assess the risk level posed by the client, and then you take an informed initial decision as to whether, for yourselves as accountable institutions, you wish to enter into or continue the business arrangement with the client. Where it's initially decided to enter into or continue with the client is based on the higher risk assessment, you can determine whether the risk can be mitigated to a level that is acceptable and that you're comfortable with, or, for example, whether enhanced due diligence is required, or whether monitoring procedures need to be implemented, or through the introduction of appropriate clauses, warranties. So that would be a right to audit clause, an anti-bribery, anti-corruption, anti-money laundering clause, or representations in the contracts that are to be concluded. And then, very important, as Ira mentioned previously, is to document the process so that if a regulator inquires on the process followed, you have the records to substantiate the procedures that have been engaged in. So steps before designing and implementing a customer due diligence process. An appropriate anti-money laundering or counter-terrorism financing compliance program must initially consider whether the accountable institution is exposed to the risk of money laundering and terrorist financing, and a risk assessment should be performed to identify those risks. And this is what it means to have a risk-based approach. You have to first identify the specific risks that are applicable to your organization before you address those specific risks, and not generic risks that may not even apply. So the customer due diligence process should be designed to focus on preventing and mitigating those key risks that may involve prospective and current clients for a particular entity. The customer due diligence process needs to be flexible to accommodate future risks that may be identified through regular ongoing anti-money laundering and counter-terrorist financing risk assessments, because the risks that you may face as an entity will change over time. Some may become more important and some less important. And it's then important that the risk assessment process is continually calibrated to address the most important risks facing the organization. A customer due diligence process should be designed to complement and make use of existing processes of the accountable institutions. It is very daunting when you start down the road of assessing your risk and implementing appropriate steps. It may feel overwhelming and that you need to develop a completely new system and completely new processes. But our advice is to use existing processes and existing capabilities within the organization, and including standard client vetting processes. You may need to enhance and adapt and extend certain of these processes, but it makes most sense to harness what is already in the organization and what already exists. So including standard client vetting processes, including financial stability, credit scoring, which is something that your procurement divisions would typically do, and other processes that may already be in place in your organization, such as anti-corruption, sustainability, anti-fraud, and anti-sanctions measures, to ensure that clients and prospective business partners are not engaging in those kinds of prohibited activities. So a customer due diligence process should be continuous throughout the life cycle of the business relationship with the client. Depending on the changing risk environment and the risk score ultimately attributed to the client, regular reassessments of the client should take place at sustainable junctures. So for example, with a high risk client, you may choose to reassess the relationship every year. For a medium risk client, potentially every 2 years, and for a low risk client, potentially every 3 years. I'll join you again at the end of the presentation to take you through the requirements of Directive 8, and I hand over to Jimmy now to take you through what a typical customer due diligence process would look like. Thank you, Jimmy.
Good afternoon, everybody. My name is Jimmy Helm, and I assist Suad and her team on matters of compliance. My focus is on the proactive side, so that's looking at assisting clients in designing and implementing anti-bribery and corruption risk management programs, anti-fraud programs, anti-money laundering, and anti-sanctions. So just to begin with, I just want to distinguish with what we're going to deal with transaction monitoring. So the process we're going to go through here is setting up a process for performing due diligence over clients. It excludes the transaction monitoring process, but of course the transaction monitoring process is a very, very important element of the whole anti-money laundering and counter-terrorist financing system. And that information from transaction monitoring needs to also be ultimately fed into the client due diligence process once we've been through the process of actually accepting the client as a client of the bank. So that forms part of the ongoing monitoring. I think it's also important to understand that that the CDD process doesn't stand independent of current and existing processes within the organization, and it is very, very important that the whole process looks at, integrates with, and complements existing procedures within the environment that you work on. For instance, your current existing client take-on processes or customer processes, they need to gel. They need to work together, and they need to complement and not contradict each other. The process would be looking at an approval matrix, and when you set up your approval matrix, so this is the process that will follow the various levels of necessary approvals within the organization in order to ultimately approve or disapprove of a potential client or an existing client. You need to take collateral review. By that, we mean you need to look at a cross-section of interested parties in your entity to provide the necessary input, to review risk ratings attributed to the client and approving the sub-processes. So, you need input from your operational department that will be transacting with the client, specialist personnel responsible for the processes involved in the interaction with the client, and various functional and management levels responsible for approval and sign-off of the decision to engage with the client. As an example, within the FIC Act, it's a prerequisite that in the case of doing business with a PEP, whether it be foreign or domestic, or doing business with close family members and known associates of a PEP, it's incumbent on the senior management to actually sign off on the client acceptance process. So you need to also link in your approval process with the requirements set out in the FICA Act. It's vital that at each step of the process, the interested parties provide and document the input, motivation for accepting the client, or note issues, red flags, or concerns identified, escalations, and recommendations. And it's vital that a clear and discernible audit trail should be established and recorded. And this again is a prerequisite of the Act. Specifically looking at Section 22 and the requirements around retention, record retention, etc. So we've outlined 7 possible steps here, and these would be step 1 being the information gathering process, step 2 an initial assessment, applying a scorecard resulting in an initial risk scoring of the client. Step 3, a review of that initial assessment. Step 4, performing enhanced due diligence processes where there are concerns or where the initial risk scoring warrants this, where the client is moving to medium to high risk. Step 5, determining whether there are mitigating measures that would reduce the risk exhibited by the client, and the risk appetite is met of your organization. And then step 6 would be approval of the client. Step 7, monitoring of the client. And at step 7, the transaction monitoring then kicks in as well. And information from the transaction monitoring should also be fed into that ongoing monitoring process. So if we look at step 1, the information gathering process, very often this commences with the completion of a questionnaire by the client. We must stress, Era's mentioned it already, you have to consider POPIA, Protection of Personal Information Act, in the gathering of this information, because because the Act requires for you not only to establish identity, but to verify identity and to retain documentation proving the steps that you've taken. So there's a myriad of issues that deal with POPIA, deal with data protection, and you need to coordinate what you're doing, what you what you're gathering onto your systems complies with POPIA as well as the requirements of the Act. So steps. The client questionnaire should be designed in a manner to alert you to potential red flags, and the questions that you pose to the client should be specific and referring back to errors discussion, and specifically referring to slides 23, 24, and 25. You will get a copy of the presentation. Those questions that are posed are going to be issues such as establishing the identity of the client, where the client is actually acting on behalf of another entity, like providing a brokerage service, agency service, etc. You need to establish the authority of the person to act on behalf of the ultimate client, as well as establish the identity of the ultimate client and the identity of the third party acting on behalf of the entity. Determining the nature and envisaged or existing business relationship with the organization. PIP or FPPP status, three-letter acronyms are not my forte. I've actually printed it on a document here. Domestic prominent influential person, a PIP, and foreign prominent public official, an FPP. Determining their status, because their status requires various other due diligence processes to take place, as Era's already pointed out. Relationship with PIPs or FPPs. So in other words, is the client an immediate family member or a close associate of a politically exposed person or prominent public official, local or foreign? If it's a legal structure, that is the client. Part of this questioning process will be to extract from the client the nature of the legal structure, the form of the legal structure, the beneficial ownership and control of the entity, and information such as key management of the organization. Again, these are parameters that are taken into consideration and also help inform you as to your risk scoring basis as well. So if you have an entity that has a very simple legal format, it's a good thing. If you have a company with an intricate or involved or unduly complex legal structure, where you've got legal entities as shareholders, where you've got offshore entities as legal shareholders, entities that are registered in the BVs, the offshore jurisdictions, etc. Those all need to be gleaned from the client, and that will help you inform you when it comes to the rating business. Source of income and wealth of the client, that includes the so will the client be using the particular or be transacting, and the sole source of income is a salary? Is it funds through a trust? From a legal point of view, what is the actual business of the operation as well, and then having a look at whether the products that are being applied for, in fact, are in line with the nature of the business of the business. Declarations regarding reputation, including violations of law and regulation. That's not a requirement under the FICA Act, but again, it's something that will inform you as to the entity. So a series of questions, including previous criminal records, legal proceedings against the entity relating to reputational issues, etc., are important for you to deal with in your normal take on of a client. And then also requesting financial information that may not be publicly available, not in the public space. So, you know, if it's a listed entity, sure, you can get onto the website and you can download the annual financial statements and integrated reports of the entity. But if it's, you know, if it's a PTY limited, or if it's a closed corporation, if they still exist and people still use such entities, sole entrepreneurship, etc., you're going to be asking for some information there that'll help inform you. The initial assessment, how we've put this together is a two-step process. So an initial assessment process, and then a determination of whether the client falls within scope with enhanced procedures. You may want to simplify it as a one-step process, where you go through the initial pre-screening and then delve into the further things. So I've lost the slide. Thank you. Okay, so as part of the pre-screening process, you're going to consider the responses and supporting material provided by the client. You're going to consider principally the nature and complexity of the business relationship, including the values involved in the relationship and transaction. And you're going to do a little bit of due diligence through public record research on your own at this initial stage. Next slide, please. With the determination that the client is in scope, and when we say in scope, after the initial assessment process, you may feel that it's a straightforward. The person is an employed person. He's a taxpayer. He's a South African citizen. He's provided you with information pertaining to his employment and his employer, and he's applying for a simple product, or the transaction involves simple goods. In the process, you may want to already at that stage go through the approval process. If it's more complex, we then move into the in-scope assessment. And as I've said before, the initial process would be looking at a review of easily accessible public information on the client. Simple things such as Google searches will often help you with determining reputational issues if they are major issues. At this stage, you're starting to look at the risk factors as well of your organization, and you're comparing the client against those risk factors. Suad's mentioned it and stressed it. Era's mentioned and stressed it. Before we get into any of these processes, you need to actually determine where your risks lie within your organization. You have to perform a proper and adequate risk assessment so that you can determine on a risk focused basis as to where you're going to focus your efforts. It's not possible for organizations to focus their efforts on every facet of the business. So that initial risk assessment is incredibly important. At this stage, you're going to apply a risk or a scoring mechanism. And you know, if you look at some of the questions that you've posed, some of the issues that you need to deal with, does the product allow for third-party payments? You're going to attribute a score to that, because if it does, it's going to score higher than a simple product. Is it transnational, cross-border transfers? Is it transactions that are going to be in foreign currency, in British pounds, in UK, I mean, in euro and in US dollar basis? Because all of those processes increase risk. Dollar-based, for instance, you know, all of a sudden you're starting to fall foul of the US authority and the Department of Treasury, who have deemed that any transactions based in US dollar currency fall subject to the cross-border scrutiny of the US authorities. So you're going to set up that scoring mechanism, and then you're going to come up with a risk rating for the particular client. Next, please, sir. Once you've come up with scoring, so you've got a client that rates high risk. A review process should be taking place here, and the reviewer needs to be somebody within the organization or persons within the organization that apply appropriate skepticism and common sense to the responses, motivations, and the risk scoring attributed during the initial assessment. You may find that on your scoring mechanism you're coming out with a high risk, but on an appropriate review of it, it's quite clear that this should be no higher than a medium risk, and so you're going to build in an overriding process within your process, so that you can adjust upwards or downwards, allow for additional procedures if required, require additional information, initial documentation from the prospective client before final risk rating is assigned to the client. So your process has to be flexible as well. Next step, please. With the enhanced due diligence procedures, you may determine that if a client is rated medium to high risk, you're going to move into an EDD process, and this is doing a lot more than simply looking at Google Translate. So at Google searches. What you're going to be dealing with here is you're going to need proper screenings here. You're going to need screenings of reputational risk. You're going to need screenings regarding to sanctions listings under the FICA Act. It's a requirement to screen PEPs, PIPs, and family members / associates with the UN sanctions. But if you're dealing with the US dollar, you've all of a sudden got to start looking at the OFAC listings on sanctions. So it's traditionally performed by third-party providers who have access to large systems. We're talking about systems like WorldCheck, LexisNexis, etc., that provide that type of screening. You may require site visits. You may require interviews with the client, or in the case of a legal entity, with management and employees of the prospective client. In the modern age, much of our take-on procedures from a client and customer base are now dealt with electronically, and there may be a need for face-to-faces on it. So that's all part of that enhanced due diligence procedure. And once you've gone through that whole process, you're going to feed that into that assessment for the high-risk client, and then determine whether a new risk rating should be applied to it or not, or whether it stays. And then we move into the next level for the approval process. On step 5, so if we can just move to step 5, we also build in a way of looking at how we can mitigate those measures. Are there measures that you can apply that will bring down the risk rating of the client? It's a client or a customer that you want to do business with, but you believe that there are appropriate mitigating measures that you can enforce within the organization and in your transaction with the particular client, which you believe will mitigate those risks and provide you with the necessary comfort to actually enter into the business relationship. And then the final step is approval of the client. And again, this approval process may follow different legs. So you may attribute certain members of your organization to approving low-risk clients without it needing to go to the highest level of approval. You may require that, for instance, where senior management has to give approval on a PEP or PIP or relationships to those persons, you may require a 2 or 3 level approval process before it hits the CEO for approval. So you go through that process. if the risk rating attributed to the client remains high, and the organization is committed to entering the business relationship, then that approval should automatically be provided by senior management, irrespective of whether the client is a PIP or a PEP or an associated, a close associate or family member. And then step 7 is monitoring of the client. And it's very important. This is an ongoing process. So, so as part of your client due diligence process, you're going to need to build in automatic reassessments of the client, and you may determine that if it's a low risk client, unless something happens, some information is brought to your attention, etc., you may want to reevaluate a low risk client on a 2-year or 3-year basis. If it's a high risk client, you're going to have to be doing that a lot more frequently. The Act doesn't prescribe it, but the Act makes it clear that you need regular assessments. Also, your risks may change. You may introduce new products. You may be selling different goods, new goods, to customers and clients. And so it's an ongoing process. Your risk assessment is going to change, and your client due diligence processes need to change accordingly to take into consideration the risk. So that's the process. And what a typical client due diligence process would look like. So it's just going to take you on Directive 8 and the screening of employees. I know it's causing a heck of a lot of concern for organizations at the moment.
Thank you very much. Thanks, Jimmy. I see that people are dropping off. We've reached our time limit. Thanks so much for joining us. Our apologies once again for starting late and having technical difficulties today. Cindy, if you wouldn't mind sharing the last screen. In respect of Directive 8, the FIC has released PCC 55, which sets out some guidance in respect of following a risk-based approach towards evaluating your employees. It requires that employees be screened for both competence and integrity periodically. And it sets out a number of requirements against which they should be screened. We will circulate the presentation to you at the end of this webinar. If you have any questions, please feel free to reach out to myself and Ira. We are able to assist you to implement a client risk-based approach towards assessing them, and as well as assisting you with the screening of your employees based on competence and integrity. So please feel free to reach out to us. We will be having follow-up sessions. And if you have any questions, drop them in the chat box or in the question and answer section, and we will circulate answers to those questions. Yeah, any final words?
No, thank you so much, Jim and Suad, for joining us today. Thank you, everybody else, for joining us today. If we didn't get to your questions, sorry, we ran out of time, but like we said, pop them in the chat or send us an email. And if you need any assistance with a risk-based approach, with RMCPs, with registration, whatever, we can assist you with all things FICA, POC, and FICA-compliant. So please, thank you so much. Goodbye.
Thank you. Bye-bye.